Greetings, everybody. Ed Denny here, sort of here. I think I told you last time that I was going to have a little retina procedure, and everything went quite well. The only thing is, it's 7 days of recovery staring at my feet. So I figured I didn't want to subject you to having to look at the top of my head. So here I am with my video blacked out at the top right corner, but I'm able to share my screen and have a good conversation with you without creating any evidence that my doctor can go to show that I wasn't sticking to protocol, which is again staring down. It's really an amazing procedure, and on top of all that, when you recuperate, you can order some equipment to help you keep your head down. So, you're all familiar with those massage chairs at the airports. Well, that's kind of what I have here, and but I have to keep my head kind of horizontal to the ground. The good news is, for me, is that there's a little desk that is attached to it, so I can put my laptop there and keep myself busy. I also have an interesting little mirror that allows me to watch TV, but only got a couple more days to go. Wednesday, I'm going to see the doctor, and that should be it. Apparently, this is fairly common, especially as people get older. There was this thing on 60 Minutes last night about Australian football, and this American who's just a really tall guy and very successful over there had problems with both of his retinas, and apparently had that repaired pretty well. So I hope you don't have any health problems, but it's the nature of getting older, I suppose. Well, the nature of getting older is you also live through quite a few of these experiences in the stock market, and you gain a certain amount of experience. One of the experiences that we've all tried to get a handle on is whether the go away in May and come back in October adage makes any sense. And there have been lots of times when it did in fact make sense to go away in May. But the problem was that when you had to come back was a little tricky, because you could successfully go away in late April or early May, only to discover that the market made its low in July and then took off from there. So the problem with all these trading strategies where you try to pick tops and bottoms is you got to be smart twice. You got to pick the top, and then you have to pick the bottom. If you don't pick the bottom, you wind up buying back at the top or higher than that. So this is just a case for being a long-term investor. I tend to, as I said before, I tend to side with Warren Buffett and Jeremy Siegel view of how one should invest, which is for the long run, and stay with the stocks, accumulate the dividends, and get rich slow. Well, having said that, let's take a look at the short-term situation in the market here. Now that I'm a long-term investor, let's look at kind of the daily moves in the market we've been experiencing for a while here. And it's interesting to note that there's a little dotted line there at the 4,000 level that goes back to the summer of last year. The market's basically been fluctuating with a lot of volatility, maybe less so recently, around 4,000. That bear market, the actual bear market, where we were down more than 20%, only lasted a few days. For all practical purposes, it was a correction. But that's easy for me to say. All of you folks, I'm sure, have had your experiences with some misery here in this bear market, especially in the technology area. But of course, that's the area that's come back the most smartly when we look at the performance rankings. Where's the market going to go from here? Well, I'm thinking that we've got still this debt ceiling crisis to contend with. I think the market's fairly jaded about these things, and again, from having lived through these things, most of us, we know that the politicians put on a good show, and then in the last moment come up with a solution. And if they don't, we know that we can scare the living daylights out of them by having the market swoon by 1,000 points for a day or two, more than that if necessary. And then that gets their attention and they pass the debt ceiling measure, and we go on to other issues. Well, another issue besides fiscal policy, of course, is monetary policy. And Tuesday, Wednesday is the FOMC meeting. I really think that they made a mistake going up by 25 basis points at the last meeting. That was 2 weeks after the start of the banking crisis. I thought that was kind of irresponsible. And I think it would be also responsible for them to do 25, but they seem to be talking that way. And so if they do 25, I still think whether they do 25 or not, 25 or 0, I don't think they're going to do 50. That would really be irresponsible. Whatever they do, 0 or 25, I think there's going to be a pretty strong signal that the Fed's thinking about pausing for a while, being data dependent, of course, not ruling out further rate increases, but they're going to have to acknowledge that there's still a banking crisis out there. JP Morgan buying First Republic doesn't end the problem. The problem is money market rates have soared, the Fed tightened, and that's caused disintermediation. Money has come out of deposits, it's gone into money market mutual funds and other kinds of money market instruments. And for a while there, the banks were able to get away with keeping their deposit rates low because there's a certain amount of inertia among depositors. They don't day trade, they don't watch what's going on in the money markets on a regular basis. But I think, ironically, the banking crisis brought it to their attention that they were getting ripped off in the deposits. And so now the banks are under a lot of pressure, and they are raising deposit rates so that they don't experience disintermediation. But the problem with that, of course, is that the cost of their liabilities is going up. And unlike the big money center banks, which seem to have a lot of loans tied to short-term interest rates, a lot of the regional and small banks have a lot of loans with fixed rates or rates that don't adjust that quickly. And as a result of that, that puts a real profit squeeze on them. I argue that the resolution for all this is going to be very similar to what happened with the S&Ls back in the late 80s, early 90s. It takes a while. There's a lot of small banks that probably need to be consolidated, merged, acquired, and that'll happen over time. And while that's happening, that may restrict the amount of credit that's available in the system. And obviously the bears, the pessimists, the hardlanders are convinced that this is the event, this is the thing that's broken as a result of the Fed's tightening, and the yield curve inversion predicted this. But now their premise is that this is undoubtedly going to lead to a credit crunch and a recession. It's a legitimate point. I'm not saying it's unrealistic. As a matter of fact, we're still sticking with our 60% hard, let's do that again, 60% soft landing and 40% hard landing. So we've always acknowledged that there are risks in this environment. But on balance, we've been optimistic and bullish on the market, especially since we think that the October 12th low was the low. So meanwhile, from a PE times E perspective, the market is kind of fairly valued. If you take out the mega cap 8 stocks, I think we're around 16 and a half forward PE. The forward earnings, as you can see in this chart, the red line, they've been going sideways for a while here, so that's encouraging. I think a lot of analysts were starting to read the recession memo or get the recession memo and read it, and started to cut their earnings estimates for 2023 and 2024, as you can see. But I think of late, while they're still cutting, they're cutting at a slower pace. And 2024 is really the key number. Increasingly, what will happen next year is more important than what's going to happen this year, because every single day as the year passes, we're going to be giving more weight from a forward earnings perspective to next year's number. Undoubtedly, that'll be lower than where it is now, but maybe not a heck of a lot lower. We're still using 225 for this year and 250 for next year. And we're definitely the outliers from what I gather on the earnings side. We are going to take a look at the final results on the current earnings season and decide whether we want to shave off a little bit from our heady expectations for this year and next year, but stay tuned. Meanwhile, encouraging us to stay with our current position, Joe Abbott, my colleague, my sidekick, put together this kind of a clever chart where we're looking at the percent of S&P 500 companies. Wait a second. Okay, somebody was complaining they couldn't hear anything, and I just realized my mic was away, so you probably heard some distant echo. But Sharon, if you can let me know you can hear now, that would be much appreciated. All right, moving along here. One of these days I'm going to get this right, get everything working in order. So if anybody else is having a problem hearing me now, after I put the microphone back in my face, let me know. So we're looking at this chart here of the percent of S&P 500 companies with positive 3-month percent changes in forward earnings. And I think it's a pretty neat kind of chart. It shows that during bear markets, analysts are cutting their estimates. This is kind of a breadth measure, and it shows that the breadth of earnings cuts hit its low right near the end. Oh, sound is great now. Thank you, Nick. Sorry about that. As you can see, we heard we saw the breadth measure here bottom right after the end of the bear market. Again, that's my view. There's others who think it's not over, and I'll admit it ain't over until it's over. But that's what makes this so interesting and fun, especially when things are going the right way. But here you can see that the breadth measure is up to 64.5%. So it's going up. It's not going down, and it's kind of more like what we had in 2000, 2001, 2002, just kind of a brief period where we were below there. But of course, this is a radically different environment now than what we had back then, because this time tech stocks actually have earnings. Speaking of tech stocks, speaking of mega cap stocks, let me go back to this table. This is all in that QuickTakes that we sent out yesterday. Because of my little eye surgery, I asked Jackie Dougherty to write the morning briefing this morning. She did an excellent piece on China, by the way. We have not been fans of investing in China, as you know, so you may want to read that. But she kindly switched from writing. She usually writes a lot of the Thursday piece, and she wrote all of the today's piece. But anyways, there's some controversy here about whether this, but yeah, the bears are saying, well, it's not fair that the mega cap 8 are accounting for all of the increase in the market. And if it wasn't for them, it still would be a bear market, and it's not good to have a narrow bull market. It's not sustainable, and yada, yada, yada. Well, again, I'm not trying to dismiss them and minimize them. It's just, we all know the story already. It's been said several times. You know, we on a regular basis do these sorts where we sort the performance of the S&P 500 sectors and industries from best to worst over different periods of time. And in this case, as you can see, we have it from October 12th of last year, which again, we think was the bottom of the bear market, beginning of the bull market, through Friday's numbers. And we don't have the individual mega cap 8 in here, but we know that they sit in information technology, they sit in communication services, and consumer discretionary. So they obviously have an impact. And information technology is up 29.7%, the best performing sector since the start of this bull market. Communications 23.2. So clearly the mega cap 8 have had an influence there. But if you look at individual industries, casinos and gaming there's no mega cap 8 in there. Semiconductors, well, I guess we got an NVIDIA in there. Healthcare supplies, home building, obviously no mega cap 8 in there. Healthcare facilities, reinsurance. Just look down there and you can just see everything that's up by 20% or more. There's been plenty of industries that have performed just fine in a very bull market kind of fashion. The problem we have now with this market, I don't know if it's a problem, the reality is that 25%, 24% of the S&P 500 market cap is in fact the mega cap 8. So clearly they have a disproportionate impact on the overall market because they account for so much of the market cap. And a lot of managed money can't go 25% in 8 stocks. It's just too undiversified. But this table here indicates that there have been plenty of industries outside of those that include the mega cap 8 that have done quite well in this move to the upside. I'd like to move on to, let's see if I can do this. Let me try sharing again. Share screen. Yeah, I wanted to just go over this rolling recession idea some more. Maybe you're bored to tears by it already, or you know that's where we're coming from. But you know, Jamie Dimon just bought First Republic. Probably got a good deal there, I would presume. It's kind of ironic that J.P. Morgan is bailing out the financial system yet again. It was in 1907 that J.P. Morgan, the old man himself, bailed out the financial system in 1907. But as a result of that crisis, there was a lot of political pressure to create a bank, central bank in the United States, which was finally done with the Federal Reserve in 1914. And arguably, it hasn't been. It's been flawed in some ways. Somebody just asked, what are the mega cap 8 stocks? Yeah, the reason the camera is showing a dark cloud for those of you who just got in is I am keeping my head down to the ground, and I did want to subject you to the top of my head here. I'm just getting over this, recovering from a retinal procedure. But the mega cap 8 are the the big techie kind of names. They're not all in tech, but it's Microsoft. It's the old fangs plus Microsoft and Tesla. But anyways, let's go back to this idea of the rolling recession. So Jamie Dimon bought the First Republic, and for some reason felt he needed to say that this does not mean that the recession risk is no longer out there. He's still worrying about a recession in the second half of the year. Charlie Munger, Warren Buffett's sidekick, was quoted on Friday as saying that he thinks that there's a lot of problems still ahead in commercial real estate. And then Elon Musk, the fellow who runs Tesla and everything else under the sun, lots of other things, including as the proprietor of Twitter, tweeted that it's getting harder to get an auto loan. So he's basically raising the flag on the auto industry. I guess all these things could in fact add up to a recession in the second half of the year, or else it could just be a continuation of the rolling recessions that we've had all along. Since the beginning of last year, when the Fed started to tighten, we had a housing recession, but it wasn't really a housing recession across the board. It was a single family housing recession. The multifamily housing has been continued to be quite strong. Then last year, particularly in the second half of the year, we basically had a goods recession because consumers segued away from goods to services. And there was a big pileup of unintended inventories in the goods providing sector. And what those companies did is to deal with to get rid of them, they cut their prices. So we had a lot of discounting, and that helped to bring the CPI and deflator inflation rates for goods down substantially. And also they cut back their orders. So there was a recession in the goods sector, which was visible in the purchasing managers survey. And even this morning, we're saying that maybe we're finally starting to get out of it, because it looks as though the MPMI ISM index is starting to move higher, which I think is the case that I'd be making from here on. And then another area where we're probably falling into a recession is construction outside of residential. Again, residential has been kind of mixed, but if you look at this chart, you can see that total residential construction is still basically at an all-time record high. This is in current dollars, which might have inflated some of these numbers over the past year or two, but still it's an all-time record high. Look at residential, that makes sense, and that's all single family. Multifamily has been holding up just fine. But look at non-residential, all-time record high, and look at public, that's continuing to move higher, and I think it's going to continue to get stronger and stronger as a result of the infrastructure spending that this administration has got money for. So here's the new single-family construction, that's down. You can see the new multifamily maybe getting toppy, but it's not down. And then there's home improvements, which is looking toppy, but it's basically close to its all-time record high. Then when you look at non-residential construction, look at this. This is, we all know that office buildings are in trouble. I think that's basically included in this commercial properties, and that looks like it's topping out. Manufacturing, however, is going straight up, and that reflects onshoring, nearshoring. Well, it reflects onshoring, not nearshoring. And all this money that was allocated for semiconductor plants and so on. Transportation structures is going up. Healthcare is going up with the baby boomers having to get retina procedures and all that. It was interesting. I went and got the procedure at an outpatient part of the hospital. A few years ago, the hospital said, we instead of crowding everybody into the same location, why don't we start building some satellite hospitals that specialize in certain areas? So I thought that was kind of indicative of what healthcare is doing. It's expanding. Now look at public construction. Look at sewage and waste disposal. I mean, it's a relatively small number, but it's going up quite sharply. Highway and streets, all-time record high. So again, we can certainly have a recession in the commercial real estate market, but let's be specific about that. It's probably in offices, and a lot of offices are probably going to get converted into apartment buildings. But there are lots of other areas in the construction market that are strong, and you can see that in construction employment, basically near its all-time record high in March. Well, with all that yapping away by me, why don't we open it up for a little discussion, and let's see what we've got here. And well, actually, we don't have much. Anybody have any questions? I'll wait a minute or two. I couldn't possibly have covered everything on your minds, but maybe I did. I spoke pretty quick. I'll wait another minute, and if we don't have any questions, we'll call it a day. Well, oh, there we go. Okay, here we go. Thank you. Okay, Gus, thanks. So Ed, in your rolling recession scenario, what is likely to be the next group? Well, I think it's, I think Elon Musk is right that it's going to be autos as auto credit conditions tighten. But the good news is that it's not as though we've been having booming sales in autos. So, if you don't have a boom, the downside potential isn't as great. And look, there's still a lot of people, a lot of these cars have been built for people with incomes and that don't necessarily need to get a loan. The whole auto industry seems to be catering to the upper end. That's where the profits are. And maybe that's all going to change. Maybe maybe we need to have more autos that are cheaper than what's available now. But all in all, I don't see much of an auto recession out there. And who knows? It might be that the light trucks sales continue to hold up. In the commercial real estate offices, as we just discussed. The key, of course, is the consumer. And the consumer, Jamie Dimon's been saying that the consumer is running out of excess savings that were accumulated during the pandemic, and that those excess savings are going to be depleted by the second half of the year. And that's when we get the recession. I got to believe that if we don't have a recession by the second half of the year, a lot of these folks are going to start talking about a recession in 2024. So we're never going to be rid of that issue. But on the other hand, that's a good thing. Kind of the wall of worry issue, or that the market likes to go up on a wall of worry. From a contrarian perspective, it's great that so many people think a recession's coming, because it's never happened before that we've had such a consensus of opinion that a recession is inevitable. So that's my answer to you, Gus. Thanks. Okay, did JPM get a good deal? I'm sure they did. I have no doubt about it. Probably went to the government and said, we don't really have to do this deal, but you need us to do it. So let's come up with some terms. I don't really know the details of it, but I'm sure it's a good deal. I think they might have wished that they could have acted quicker, because some of their wealth groups bolted and went to other places. Let's see, will the FOMC statement be dovish? I hope so. I hope that whether they do 0 or 25 basis points, and that, I think, is really the options of what they're likely to do. Whether they do one or the other, I think that they've got to strongly hint at a pause, given the banking crisis. I mean, they got to understand from history that the yield curve has a pretty good predictive power of saying that if the Fed keeps tightening, something's going to break. I mean, why else would anybody want to buy a bond at a yield below a 2-year? And the answer is because they think that if the Fed keeps raising rates, it's not worth parking your money in short-term rates, because those rates are going to come tumbling down when something breaks, causes a credit crunch, causes a recession. So I think they'll be dovish. Let's see, Arnold, I wish you a speedy recovery. Thanks. Thank you very much. Let's see, let's move on here. What's your thoughts on artificial intelligence? Some think it's great, other thinks it's dangerous. Any thoughts? That's a really good one. I'm like everybody else, I'm fascinated by it, reading a lot about it. One of my professors at Yale that was on my PhD committee now is a professor at Pepperdine in California, and he's a statistician and an economist. And he's written, his name's Gary Smith, and he's written a lot of stuff on artificial intelligence, and basically pointed out that artificial intelligence is artificial. There's no, there's no kind of the ability of artificial intelligence to kind of think the way that humans do. All that artificial intelligence does, it plays a probability game of based on kind of historical precedent of all the information that it's collected, what word should follow this word, and so on and so forth. And it does it at the speed of light, and it has been pretty interesting. But I asked it to write a resume for me, and it got me about half right and half wrong. We're still going to need humans to check over what they're doing. But on the other hand, this is all brand new kind of stuff. I mean, it's been going on for a while, but it's all sort of become commercial. We all have access to it now, and it's just the beginning of artificial intelligence. And hard to say how much more intelligent it's going to get. But I like to watch some of these sci-fi shows on TV, but there's no point in watching them anymore because science fiction is becoming reality here. Let's see, I missed the beginning today. Did you comment on the Fed and their potential pause? Yeah, we just kind of covered that in the question. And I'll take one more here from Nick. Looking at the Fed's action after SVB, do you think that the 1-year window for special financing was a great move to cover the concern over bank runs by depositors? If so, do you think it will be extended? Yes, and yes. I mean, sometimes these liquidity facilities, just by creating them, diminish the need for them because everybody kind of calms down and you don't have the bank runs and the liquidity crises. So I think, they had a lot of experience in 2008 with playing whack-a-mole with these liquidity facilities, and they worked really well. And this one seems to be working really well. The Fed made it clear that they're not insuring all deposits; they're guaranteeing all banks will have liquidity, so that there doesn't have to be a banking crisis. And so far, we've been tracking the commercial bank data. For those of you who want to do it on your own, with our data, with the data that we put together, if you go to the website and go to Global Money and Credit, and under U.S. Money and Credit, there's Commercial Bank Book and Commercial Bank Loans. And the Commercial Bank Book picks updates automatically all of these charts, and that come out weekly with the Friday report. And here you can see, here's bank credit. It was up during the latest week. Securities up, loans and leases up, deposits were up, and borrowings were down, or if you can barely see it, but they weren't up. So I look at this and I said, looks like things have been calming down, and this is what we'll be having to watch on a weekly basis for a while here until this is behind us. I'll take one more question from my good friend Paul. Good morning, Ed. If a recession or slowdown is inevitable this year, why is the stock market not reacting? Also, do you anticipate the Fed cutting rates later this year? It just seems that the likelihood of cuts this year is nearly impossible. Would not be a big slowdown. Would that need a big slowdown? A lot of questions there, but the bottom line of my thinking on all this is that the Fed, I don't think the Fed wants to cut rates. I don't think they will cut rates because I'm in the soft landing camp. If I was in the hard landing camp, I think that's why it's so prevalent, is because a lot of hard landers out there that are thinking that the Fed's going to have to ease in order to offset a hard landing. But I think inflation will moderate to 3 to 4%, but that still will be above 2%. So I see them, if they listen to me, they should leave it here at 5%, leave it here for the rest of the year, let inflationary pressures continue to moderate, particularly in the rental area of the services. And I think then they'll be able to conclude that they succeeded in bringing inflation down without causing an economy-wide recession. So that's where I'm still thinking. Well, you've all been very kind to join me today. Let's do this again next week when I'll be back, not behind a black screen. Thank you.